Conversation with Yogesh Patil, the Director of Research at Oil and Gas for Dolat Capital, and let's understand what's been happening with oil and crude and the multi-day plunge that we've seen. We're also being joined by Vandana Hari, the founder and CEO at Vanda Insights. And Yogesh, I'm going to come to you first. Help us understand why we have seen this multi-day plunge when it comes to crude. It's below $70 per barrel right now. At what level are you expecting Brent to stabilize? What are your targets, and what do you think is the road ahead when it comes to Brent crude prices?
Yeah, thanks and good afternoon. Recent correction in oil prices is mainly due to a kind of a confirmation from OPEC plus countries to pump more oil at the rate of 138 kbpd, which will increase every month. In addition to this, the trade war or the tariff war can create the possibility of slowdown in major economies, which is expected to slower the oil demand growth in a calendar year 2025. And other side, the global oil supply to increase around 1.5 million barrels per day. So this clearly indicating a oil surplus in the market 2025, where the crude prices floor would be in the range of $60-65 per barrel. And we believe the average crude price for the quarter second calendar year 25 would be $70 per barrel.
All right, that's the take, and that's likely target for the crude prices. But Vandana, very good afternoon, and thank you so much for your time. When we see Brent, that is definitely going down, but at the same time, rupee is weakening, and there's a risk of share moderation in Russian crude discounts benefit for the refiners due to US sanctions on Russian vessels. What is the net impact of this as per you?
Good afternoon. So I think it's going to be quite a mixed impact on India and Indian refiners. So first of all, as you were just mentioning, flat prices have come down considerably for crude. Overnight, the settle for benchmark crude prices was at 4-month lows, Brent below $70 a barrel. Now, a drop in the flat price is definitely good news for Indian refiners. How long this sustains is hard to say, because I would characterize this slump that especially the one that we have seen in the last few days, as a response to all the tariff wars that are emanating from Washington. But these tariff measures are highly unpredictable. They're quite chaotic. There's a lot of U-turns and exemptions and suspensions and whatnot happening. So we might see crude prices recovering, but still I think probably remaining more in the low 70s for Brent. So that's good news for Indian refiners. As far as Russia is concerned, now we know right now the whole ceasefire agreement that the U.S. is pushing for is a little bit on ice because of problems between U.S. and Ukraine. But really, either way, I don't see Russian crude flows into the market being impacted. So all in, it doesn't make any difference for, again, flat prices for crude. As far as the discounts for Indian refiners are concerned, I think as long as the pressure of sanctions is there on Russia, the pressure of a lot of ships in the ghost fleet being out of commission, there will be some discount. Of course, we've seen that discount wax and wane. But going forward, depending on what the U.S. does with Russia sanctions, I think this Indian refiners should be prepared for continuing volatility in the discounts, but some amount of discount will remain.
Okay, thanks for that view, Vandana. Yogesh, coming back to you, tell us about the impact that you see on the back of this fall that we've seen in Brent. How much do you expect the margins of OMCs to improve due to the decline in crude oil prices, and how much of this will be the EPS impact of upstream companies? What's your view here?
Yeah, so crude has declined more than 10% in last 2 months, while the INR is depreciated by 4%. So the net impact on the marketing margins of the oil marketing companies is still positive. OMC's integrated marketing margins, integrated margins on the auto fuel on a spot basis are more than 12 rupees per liter, and also higher than the long-term average. If we look into the long-term average of integrated margins of these oil marketing companies are more than closer to 11 rupees per liter. And right now on the spot basis in last 2 to 3 days, we have seen that 12 rupees per liter. So this is in a better shape, better situation. We believe the crude prices are expected to remain in the same range of $70 per barrel. And we have seen the sharp improvement in the GRM also. Singapore benchmark GRM has recovered in last 3-4 days, and that is closer to $5 to $6 per barrel. And this would be favorable for the earnings of the oil marketing companies. That's one thing. Now only the question remains for the domestic LPG under recoveries, which has mounted to the level of 25 to 27,000 crores in the last 9 months FY25 and expected to touch the 40,000 crores in FY25. Based on our understanding, domestic LPG is a still regulated product. Historically, government has always provided a support in terms of a grant, supplements to the OMCs for these under recoveries on the domestic LPG. So we continue to believe that the government can announce the support to OMCs by the end of FY25, and this would be a positive. And the one good part is that if the OMCs receive a support from the government, then the book value of these companies or the decline in the debt of these companies are expected. The book value can improve by 10 to 15%, and which will boost the equity valuation of these companies. That's one thing. We have accumulated recommendation on these oil marketing companies, and among the OMCs, we prefer the HPCL as the preferred pick because the HPCL is having the highest marketing to refining ratio.
All right, Yogesh, thanks so much for highlighting the stocks within the OMC basket. But Vandana, there have been divergent trends when it comes to the crude and natural gas prices. The natural gas prices are seen to be hitting 2-year high. Help us understand that. What is your outlook on the price trajectory for this one?
Yeah, so although natural gas, thanks to LNG flows across the world, is quite an interconnected market, but not to the same degree as crude oil. And what we see typically in natural gas is that the market balances and geopolitical influences in Europe, the weather in the northern hemisphere tends to impact natural gas much more than crude oil, and as a result, the two quite often diverge. We have seen a colder than normal winter in the northern hemisphere. We have seen Europe dipping into its gas storage very early on at the start of the winter season, 24-25 winter season, and which has left them their stocks quite depleted, which will, of course, need to be built up through the summer months when they use less, but that's when they try to stock up for the coming 25-26 winter. There has also been the sort of ups and downs that we have seen with regard to sentiment as to will we have a ceasefire or not in Ukraine. That sentiment has also impacted gas to a fair degree because if there is a ceasefire, there is some hope that perhaps Europe could get more gas from Russia. Whereas, as I mentioned before, it's of no consequence almost to global crude balances. So all of these factors have made gas a little more volatile, I think. But we are coming to the tail end of the northern hemisphere winter season. I think you will see some of that volatility come down. But as now European nations scramble to refill their storages through summer, you could see again gas prices remaining elevated.
Okay, Vandana, thanks for that view coming in. And Vandana and Yogesh, thank you so much for joining us on the show and talking about the impact that the fall in crude could have on OMCs as well as city gas distribution companies, and what are the next levels that you're targeting for crude.
If you like this video, then like, share and subscribe to ET Now.